We are going to start chapter number 14, that is Firms in Competitive Markets, from book Essentials of Economics by N. Gregory Menkev. There are different market structures and we will going to see the firm's behavior, such as where the firms sell products, how they determine the prices, and finally how the firms can maximize their profits. So in this chapter, that is Firms in Competitive Markets, we will discuss about competitive markets, where how the firms behave in perfect competition and how they fix price and quantity in competitive markets. So coming to the characteristics of a competitive market, here we are going to discuss about different features of competitive markets. First one is there are many buyers and sellers in the market. That means there is a large number of buyers and sellers in the competitive market. And the second one is the goods offered by various sellers are largely the same. Since there are many sellers of the product in the market, so it is assumed that goods that are produced and supplied in the competitive markets are homogeneous. That is, these products are same or identical. Now the third property is firms can easily enter or exit the market. That means that whenever firms want to enter the market, they can, and whenever they want to leave the market, they can easily leave the market. There is no restriction or barriers for entry or exit to the markets in the perfect competition. Now, the fourth characteristics of the competitive market is perfect information on both sides of the market. Here both sides refers to seller and buyer. All the sellers and buyers have perfect information or knowledge about the types of products and their prices. They are have complete information about the prices and other aspects of the market. As a result of its characteristics, the perfectly competitive market has the following outcomes. And the first one is the actions of any single buyer in the market have a negligible impact on the market price. And the second one is each buyer and seller takes the market price as given. As a result of these conditions, the actions of any single buyer and a seller in the market have a negligible impact on the market price, and each buyer and seller takes the price as given. Let's take the example of milk market here. So no single consumer can influence the price if you go to buy the milk. Thus assuming that it is the same milk, we do not have like different kinds of milk, so you cannot force buying it at a lower price. That means you cannot influence the price. Then for example, we are going to talk about the seller side. Similarly, each seller of milk has limited control over the price because many other sellers are offering milk that is essentially identical. That means that the product that is milk is the homogeneous product, means it is identical and it's of the same type. Because each seller can sell all he wants at a going price, he has little reason to charge less, and if he charges more, then buyers will go elsewhere. That means that buyers are not willing to buy the milk that if any of the seller is selling it at the a higher price relative comparative to the other sellers. Buyers and sellers in the competitive market must accept the price that the market determines and therefore are said to be price takers. Buyers and the last point is here, that is buyers and sellers must accept the price determined by the market. So in the light of these characteristics, we can say that a competitive market is a market with many buyers and sellers trading identical products so that each buyer and seller is a price taker. As all buyers and sellers are trading homogeneous products, so that all of them must accept the price determined by the price takers. Now we are going to start with another topic of the chapter firms in competitive market, and that is the revenue of a competitive firm. As we know that total revenue for a firm is the selling price times quantity sold, means that total revenue is equal to price into quantity. Now if we talk about average revenue, and it will tell us that how much revenue a firm receives for the typical unit sold. Revenue received by the firm for each unit sold, you can say that if we divide total revenue by quantity, we get average revenue. That means average revenue is equals to total revenue divided by quantity. And for further resolving it, as we know that total revenue is equals to price into quantity, so here if we write price into quantity in place of total revenue, so there comes price into quantity divided by quantity. Now the quantity cancel out each other and we can get price. So we can say that average revenue is equals to price. And in a perfect computation, average revenue equals the price of the product, and we can also prove that thing, that price is equals to average revenue in a competitive market. Now coming to marginal revenue. Marginal revenue is the change in total revenue from an additional unit sold. That means that marginal revenue is equals to change in total revenue due to change in Q. If the firm wants to sell an additional unit of output, so how is the change comes in total revenue? For a competitive market, or for a competitive firm's marginal revenue equals the price of the good. So in the previous slide we have started that average revenue is equals to price for a competitive market, and now here marginal revenue is also equal to the price of the good in a perfectly competitive market. Now there is a table in which we are going to find out total revenue, average revenue and marginal revenue. There are 5 columns in the table. Quantity is given in first column and price in the second column. Then total revenue is mentioned in column 3, and then average revenue and marginal revenue. Here you can see that quantity varied from 1 to 8 gallons. And price is fixed, that is $6, and we know that price is same in perfectly competitive market. In order to calculate total revenue here, just multiply quantity with price, as the formula shows that total revenue is equals to price into quantity. So multiplying price, that is $6, with quantity, that is $1, we get $6, that is total revenue for quantity 1. As we know that average revenue is equals to total revenue divided by Q. So here total revenue is $6 and quantity is 1. So dividing 6 by 1 we get $6. Again average revenue is $6. And the next one is marginal revenue, that is change in total revenue due to change in quantity. And there is no marginal revenue for the first unit because it is the first unit of output. Similarly, you can calculate total revenue, average revenue and marginal revenue in the same way. Now coming to quantity at 2 units. So here the total revenue is equals to 12. That means simply multiplying price with quantity. So 6 multiplied by 2 becomes 12. Here total revenue is 12. Now coming to average revenue, that means total revenue divided by Q. So here total revenue is 12 and quantity is 2. So dividing 12 by 2 we get 6. Again average revenue is $6 here. Now here the marginal revenue is, as we all know, the formula of marginal revenue, that is change in total revenue divided by change in Q. So here change in total revenue means 12 minus 6, that is change in total revenue, and that becomes 12 minus 6 equals to 6, and change in quantity means that 2 minus 1. So dividing 6 by 1 we can get marginal revenue, and that is $6. And in the same way you can calculate all of these revenues, like total revenue multiplying price with quantity, then average revenue dividing total revenue with quantity, and marginal revenue by dividing change in total revenue by change in quantity. Now we can say that in perfect competition market, price is equals to average revenue and equals to marginal revenue. That means that if we want to summarize this table, we can easily say that perfectly competitive market, in perfectly competitive market, a price is always equals to average revenue, and which is always equals to marginal revenue. And you can see from here that price is equals to average revenue, and then both are equal to marginal revenue as well. Now here comes profit maximization and the competitive firm supply curve. The main objective of a firm is to maximize its profit. This means that firm wants to produce the quantity that maximizes the difference between total revenue and total cost. And there are two approaches to explain profit maximization of perfectly competitive markets. First one is total revenue and total cost approach, and second one is marginal revenue and marginal cost approach. According to the first approach, that is total revenue and total cost approach, the profit of the firm is maximum at the point where the difference between total revenue and total cost is maximum. And in the second approach, that is marginal revenue and marginal cost approach, the profit of the firm will be maximum at the point where marginal revenue is equals to marginal cost, and that point is known as profit maximizing point of a perfectly competitive market. So first approach is a total revenue and total cost approach, and the second one is marginal revenue and marginal cost approach. In the first approach, that is total revenue and total cost approach, we can say that the profit of a firm is maximum at a point where total revenue is equals to total cost. And in the second approach, that is marginal revenue and marginal cost approach, we can say that the profit of a firm will be maximum at a point where marginal revenue is equals to marginal cost. So now we will explain this phenomena, or we can explain these two approaches, that is total revenue and total cost approach and marginal revenue and marginal cost approach with the help of an example. So here is a table through which we can explain two approaches, that is total revenue and total cost approach, and the second one is marginal revenue and marginal cost approach. Again, in the first column there is a quantity, then total revenue, total cost, then comes profit, then marginal revenue, marginal cost, and change in profit, that is marginal revenue minus marginal cost. According to the first approach, that is total revenue and total cost approach, if we see here, profit can be calculated by the formula that is total revenue minus total cost. If you see in the table, just check the quantity where profit is maximum, and we can see here the profit is maximum here, and the 7 and 7, there are 2 points where the profit is maximum. First is at 4th unit and the next one is 5th unit, and the profit is maximum at that is 7 at the output level 5. So we can say that here the firm is earning maximum profit, or the firm is at the maximum profit at output level of 5 units. Now coming to second approach, that is marginal revenue and marginal cost approach. Since it is a perfectly comparative market, so marginal revenue is same for all units of output sold in the market, and that is $6. You can see that marginal revenue is same for all the units of output, that is $6. Marginal revenue is calculated by the formula that is change in total revenue divided by change in quantity. So by dividing both the terms, we can get marginal revenue, that is dividing total revenue, this column, with change in quantity with this column. So here we get marginal revenue. Next is marginal cost. Marginal cost is calculated by change in total cost divided by change in quantity. That means dividing this column, that means change in total cost, by this column, that is change in quantity. According to MR and MC approach, that is marginal revenue and marginal cost approach, profit is maximized at the point where marginal revenue is equals to marginal cost. So here we can say that this is the point where marginal revenue is equals to marginal cost, that at this point both the quantities are same, that is $6 for marginal revenue and for marginal cost as well. If you see the table at the 5th unit of output, there at this unit of output, that is 5th unit of output, marginal revenue, that is $6, is equals to marginal cost, again that is $6. And here the profit of a perfectly comparative market is maximum. And in the last column of the table, we can see the change in profit, that is marginal revenue minus marginal cost. You can see here that at after this point, that is where the profit is maximum, this one, where marginal revenue is equals to marginal cost, if the firm continues to produce, so the change in profit would be negative, and it's evident from this change. That means that firm will face loss. If at this point where the change in profit is 0, that means where marginal revenue is equals to marginal cost, and after this point if the firm continues to produce, that means the firm is in loss and the profit is negative here, and this negative profit means that firm is facing loss. It is concluded from this table that at fifth unit of output produced, this one where the quantity is 5, that means at fifth unit of output produced, the profit of a firm is maximum to both approaches, that is total revenue and total cost approach, and for marginal revenue and marginal cost approach. Here is the graphical representation of a table in which we are going to see at which point the profit of a firm is maximum with the help of marginal revenue and marginal cost approach. On x-axis quantity is measured and on y-axis cost and revenue are measured. There are different revenue curves here and a marginal cost curve as well. As we have already discussed that price is same in a perfectly competitive market, no single seller or a buyer can influence the price of a product, so price is equals to marginal revenue and average revenue. Here you can see that price is equals to marginal revenue and also the price equals to average revenue. So here revenue curve is a straight line. This one, this horizontal line is the revenue curve line. Whatever is the level of output produced and sold in the market, price, average revenue and marginal revenue will remain same. So here is a horizontal line for price, average revenue and marginal revenue. Now we have to check where the profit of a firm is maximum. Here average total cost curve, this one, this blue line, ATC, that means average total cost. Here average total cost curve is present and it is U-shaped curve. Then here is average variable cost curve, this blue line again, this one, ABC, that means average variable cost, which is below average total cost curve because average total cost includes average fixed cost also, and it is always above than average variable cost. Here is the marginal cost curve as well. Marginal cost curve is intersecting at 3 points, that is point A, point B and point C. If we look at point A, where marginal revenue is greater than marginal cost, you can see from here that this line is for marginal revenue and this one is for marginal cost. So you can say that at quantity 1, that means at Q1, here marginal cost is less than marginal revenue. That means cost is less than revenue. There is that much difference. And marginal revenue is above the marginal cost curve. Here you can see that this is marginal revenue curve and this is marginal cost. So here the marginal revenue is above marginal cost, and at this point firm continues to produce and Q will further rise. So we can say that at point A, where marginal cost is less than marginal revenue, so at this output level, that means Q1, firm will continue to produce and Q will rise to maximum point, that here firm will continue to produce at this much and reaches to point B, where the marginal revenue is equals to marginal cost. And if we see at point C, where the marginal cost is greater than marginal revenue, So marginal cost becomes greater than marginal revenue. Here is marginal cost and here is marginal revenue. So this much is difference between both of them. So at this point, that is at point C, firm will tend to produce less output and start moving to point B, where marginal revenue is equals to marginal cost. So you can see that if marginal cost is greater than marginal revenue, so firm will tend to produce less output and continues to move to point B, where marginal revenue is equals to marginal cost. And if the firm is at point A, that means where marginal cost is less than marginal revenue, so firm will start firm will continue to produce Q1 and reach till point B, where marginal revenue is equals to marginal cost. So here B is the point where marginal cost is intersecting a marginal revenue, and this is the point where marginal revenue is equals to marginal cost.